are doing a big blunder if you are daring to use the price to earning multiple to value a price, a BFSI company, a public sector bank, a private sector bank, NBFC, insurance company, or a fintech firm. Or if you are using the price to earning multiple to value or to price a cyclical heavy industrial business like a cement, a real estate, a telecom, infrastructure, defense, etc., etc., etc. The major reason for that is that if we talk about the banks derive much of their value from the book value. And the book value is composed out of the loans, the assets minus liabilities, and the liabilities are nothing but the loans the banks take and the loans the bank give it to you. The interest rate at which the bank gives the loan to you minus the interest rate the bank takes loan is a spread the bank makes. And that spread is called as a net interest margin. Because much of the profitability or much of the value of the bank is derived from the book value. And again, the book value of the loans is not just again the provisions. If I believe that some loans might default, I might put some provision to those books. So for example, if my book is worth 100 crores and if I believe that 20 crores might default, I might assign a 20 crores ka provision on that book. So 100 crores minus 20 crores, 80 crores becomes my book value, and the bank will be deriving all its value from that book worth 80 crores, that net worth 80 crores. Similarly, for the cyclical industries, the heavy industrial companies that work on multiple cycles, in that cases the price to earning can simply mislead you, because basically what happens, the basic principle of finance or the basic principle of valuation simply says invest into a cheap stock when the price to earning multiple is low, which might not always be correct, and sell a stock where the price to earning multiple is high. So we might follow that terminology, that concept, and look at those companies to pick up the cyclical companies, the heavy industrial companies having a lower price to earning multiple. But you might turn wrong in that. A cyclical company might be having a lower price to earning multiple when the earnings have peaked. The price to earning multiple will be low when this EPS is high. It might indicate the top of that cycle. The cycle has stopped out. The EPS has peaked out. And from that particular point of time, the companies might start to correct because the EPS has stopped out. Whereas we might decide to sell off a company having a higher price to earning multiple when this EPS is low. But it might indicate the low EPS has bottomed out. And now the cycle will turn around in a positive way and the EPS will bounce back. So hence, in those scenarios in cyclical companies, it's very difficult to predict the cyclicity of the EPS or the earnings of a company. So hence, for the BFSI space, or the heavy industrial companies or cyclical companies always use a price to book value multiple, or buy the cyclical companies at a higher price to earning multiple and sell at a lower price to earning multiple, which is contrarian to the general opinion in the books, that is buy a low P stock and sell a high P stock. So always make a decision upon the price to book value multiple for the BFSI space, the private sector banks, the public sector banks, insurance companies, NBFCs, the fintech companies, and as well as for heavy cyclical industries like a cement, a defense, a real estate, a power, a capital goods, a telecom, etc. Thanks.